Welcome to another S&P 500 analysis. Today is September 17, 2022. This was a week with a lot of drama. We got the CPI, the PPI, and the quad witching. The CPI came in with a surprising upside on the core inflation number, and that got the S&P 500 moving on the downside. A lot of wishful thinking. Market participants were expecting a softer number and betting it would result with a possible Fed pivot. But unfortunately, they were caught on the wrong side of the trade, and we witnessed how they scrambled to exit their longs, with the S&P 500 future dropping more than 100 handles in a single minute during pre-market, right after the CPI release. Then the PPI came out on the following day and wasn't much of an event after the drama from the CPI. But as the quad witching is near, market continued with its downside momentum to shake the longs. Then on Friday, the quad witching day, it's just a game of chop for the hedgers to unwind. So what is this week's price action leading up to? A trap for the bulls or a trap for the bears? In this S&P 500 analysis, we'll analyze the sentiment, the market internals, the price action of the S&P 500 and other major market indexes, and see what the market is up to. And is it setting up to trap the bulls or trap the bears? Stay tuned. Before we begin, a few reminders. If you have any questions for me about the tools I use for my analysis and my analysis technique, post them in the comments section. And after I have compiled a list of questions, I will do a Q&A video to answer them. And if you haven't noticed, I have started to post additional contents on my Substack page. The link is in the description below. Couple follow-up posts I did this week on the SPY gave you the update on the scenario to watch, and I hope it helped you avoid some of the carnage or able to catch a couple of the trades. Go check them out if you haven't yet. In addition, I will post a separate video on Sunday for the SPY, the QQQ, and the IWM where I will discuss price level and price scenario to watch for the coming week. And finally, don't forget to smash the thumbs up to help promote this video on YouTube. And if you are not a subscriber and you like the content, click the subscribe. Okay, let's go on to the analysis. On this weekly chart of the S&P 500, we see a bearish engulfing candle or an outside bar this week. Last week, it was a bullish engulfing candle. Also notice the low is still above this June low, and it came down to near this support zone where we expected the S&P 500 might find support. So far looking good. So we'll see will it continue to be able to hold above the support level next week. And as you can see, I also outlined the zigzag to kind of highlight the possibility of this low being a higher low if the price take out this pivot high. And for the week, the S&P 500 had a range of almost 300 points, 282.2 to be exact. It lost 194 points or 4.77%. It closed back under this 10-week and also the 40-week moving average. Now, one of the viewers asked me why I'm using the 10 and the 40. Well, the simple reason is the 10 and the 40 weekly moving average represent a 50 and 200 period on a daily time frame. So that's the reason why I'm using the 10 and the 40s to get a visual on the trend. I don't use moving average for support or resistance type of purposes. I only use them to help kind of smooth out the trend and kind of make it easy for me to see is it on a downtrend or on an uptrend. So right now we basically continue to watch for confirmation. Is this going to turn out to be a higher low? Now let's go and take a look at the sentiment and the internals before we take a closer look at the price action of the S&P 500 and the other major market indexes along with the 10-year yield, the US dollar, oil, silver, and gold. Here on this sentiment chart, we see that the S&P 500 lost 4.77% or more than 190 points. The VIX is still sitting inside of this 2030 zone. It closed the week at 26.3. One would expect the VIX would be spiked up to the 35-40 level with a week that have lost 4.77%. But the put-call ratio did spike up above 1. it closed at 1.14, and that's the highest since the June 16 close, where it stands at 1.15. Now, it appears the market participants are getting very bearish. So is this a sign of a pullback low? And looking at the New York Stock Exchange up-down volume ratio, other than the Tuesday where we saw the CPI release that spooked the market, other than that, Friday, the up-down volume ratio closed at a minus 4.46, and the daily advance decline was minus 1,485. In other words, 1,485 more declining issue than advancing issue on Friday. Now, would have expected at least 2,000 or more declining issue than advancing issue on a down week, especially on a down Friday, where at one point, Friday, the S&P 500 was at least down 60 some odd points. And on Friday, there was slightly more stock make new 52-week low than in the recent past, but still relatively low, comparing that it had 363 stock make new 52-week low versus back on June timeframe. It was like June 16. It was 1,099 stock make new 52-week low. And looking at the New York Stock Exchange cumulative AD line, it is still above this prior low here. As you can see, we have this higher low versus the S&P 500 actually closed at a new, below this pivot closing low. So you can see that it is forming a positive divergence between the AD line and the S&P 500. So that is a positive. And looking at the NASDAQ 100 lost almost 6% for the week, of 735 points. And on Friday, it lost a little bit over 0.5%, and the up-down volume ratio is only minus 3.8. In other words, 3.8 times more down volume than up volume. And the daily advance declines show 1,818 more declining issue than advancing issue. The NASDAQ new low came up to 477 stock, made new 52-week low on Friday, and that compared to the 1,143 made on June 16. And the NASDAQ cumulative advance decline line is also above the prior low, but the NASDAQ 100 index below the previous pivot closing low. So similarly to the New York Stock Exchange, the NASDAQ cumulative advance decline line is forming a positive divergence with the NASDAQ 100. So that too is also a positive. So the sentiment is showing market participants getting more bearish, but they are not getting more fearful per the VIX. The up-down volume ratio is not showing panic selling, and there is a positive divergence between the AD line and the indexes. So is the boy crying wolf, or the sky is falling type of a moment? We'll answer that when we take a look at the price action of the indexes, and also I give you my take on it at the end. Now let's take a look at the interest rate, the US dollar, oil, silver, and gold. On the 10-year yield, you can see that it came up this week. It hit a 3.49 on a high, intraday high here. And we're still looking for this thing to come up to this 3.75 level. And the US dollar showed no sign of weakening, and it continued to be heading toward this 112 level here. And I was saying that we're basically looking at this 117 eventually. And this is the major move based on this consolidation range here. Even though if it come up to this 117.67, it is still below this high here, which it was made back in 2001, in June 18, 2001. And for the crude oil, we see it still bouncing between this $45 and $90 level here. And I'm looking forward to either break above this low volume zone and move up toward this 109, basically come to this high volume area into the next low volume zone. To come to this 109, or break down and come dip below this low volume area and move down to this low volume zone, or this low volume node here somewhere around 76, 70, or basically around $77. And silver actually moved up to this balance area and sitting on the top edge of this balance area. And right now, if it break above the 20 level, which is this little bit of a low volume zone or sitting on the top of the edge, that this edge here, we could target this a ledge on this balance area, then we could see it possibly make its way up to this 22 level. Now, if it get rejected and get pushed back, then we're basically looking for retracement back down to the other side of this balance area. And that would bring it down to this 18 and 17 area. And looking at gold, gold was unable to hold this 1705 level up at this low volume zone. And it is moving into a high volume zone below that low volume zone right now. So we'll see for it to move down, pop most likely will move down to this low volume zone before we could possibly eventually a bounce back up or a impulsive move down to this lower area of the high volume area. So look for, in the near term, look for a possible move down to 1650 and then see will we get a bounce back up or will it just come right to and dip below it. Now let's look at the indexes starting with the S&P 500. On this daily chart of the S&P 500, we see the price started the week on a positive move above this high volume zone here near the 4100. Then on Tuesday, a bit of a surprise from the CPI, and we saw an impulsive move down to the lower range of the weekly expected move, and also the high volume and the trend line were confluent with that lower range expected move area near the 3940. And the downside momentum continued on to quad witching Friday, where it came down to this gap zone level and bounce. In my update stack post, I have talked about this possible bounce for the SPY. And as you can see, the S&P 500 printed a hammer on Friday. Now here are the ranges for the weekly expected move for the coming week. The expected range is somewhere around 233 points for next week. And don't forget, next Wednesday, we have the latest FOMC interest rate hike announcement. The upper range of the weekly expected move is between 4,015 and 3,990. And the lower range is between 3,756.60 and 3,735. Now here's the downside scenario for next week. Move down to this 3,800 area and fill this gap, and then possibly head down to this lower range of the weekly expected move and look for a possible gap fill near this 3,700 if it could not hold or get a bounce off of this lower range. And the possible upside scenario for next week is to move back up to this trend line and do a back test and then chop around in this high volume area and see could it push back up above the trend line and come up to this upper range of the weekly expected move. And then if we could move through this upper range zone, then look for a possibility of moving toward the gap fill near the 4037 area. And looking at the NASDAQ 100, we see the NASDAQ 100 got rejected by this low volume area, essentially this support resistance zone, and broke below this trend line again and came down and filled this gap here. And here's the downside scenario for next week. Dip below this 50% retracement level and move down to near this 11,500 in attempt to find support. And the upside scenario is to bounce off of this 50% retracement and back up to this high volume area near the 12,150 area. Now we notice the Russell 2000 peak above this 38.2 Fibonacci retracement level near 1900. Then it fell back and came down and tested this pivot here, basically this pivot high, and found support. It was able to hold above the trend line as well. Now here's the downside scenario for next week. break below this trend line and dip down to the 50% retracement level and potentially into this support zone near the 1700 level. And the upside scenario is to push back up to this support resistance zone and move up toward this 1900 level back into this price zone here. And that's basically also move it back above the Fibonacci 38.2. Now here's the ugly Dow Jones Transportation for the week. Dow Jones Transportation ended with a huge gap down, and that's due to some negative outlook by FedEx. And it closed with a new intermediate low because it closed below this June low, closing low. And also it made a new new low intraday as well because it took out this intraday low here that was made back on July 14 of 2022. So here are the scenario. Downside scenario is to continue to break down for the 50% retracement level near 12,360. The upside scenario is to make an attempt to fill this gap that left on Friday by moving back above this 13,500 up here. Now, there's a side note. I mentioned that earlier. The Dow theory is in play because this low here is unconfirmed, and that could have negative implication for the Dow Jones Industrial. And looking at the Dow Jones Industrial, we see that it broke this trendline support and came down and filled this gap here near the 30,600. And also it printed a hammer doji on Friday. It still have not dipped into a bear market territory during this entire downward move. Even this June low here, it did not lose more than 20% or more from its all-time high. Came down here, it was 19 point some odd percent here, even measured from the low. Now here are the scenarios. The downside scenario is to dip down toward this 38.2 Fibonacci retracement level near 29,800 and then test the June low. The upside scenario is pushes back up above the 3150 level, essentially getting back up above the trend line and possibly make a move toward the 32,000 level. And finally, the New York Stock Exchange Composite Index, it came back down and retest this pivot level once again. And end of the week actually closed below this pivot level. So we're looking for a downside scenario to continue to move down, to possibly come down and test these double bottom level here. And we're basically looking at this retracement level somewhere around 14,100. Now the upside scenario is to get back above the double bottom pivot high and move back up above this 15,000 pivot high level here. So in summary, the indexes have pulled back below the prior week's low. Other than the Dow Jones Transportation, all the indexes are still above the June's low, and most of these finish off the weekly low. Market participants are getting bearish but not fearful or panicky. The move by the Dow Jones Transportation this week has some potential negative for the Dow Jones Industrial per the Dow theories. The divergence between the cumulative AD line and the S&P 500 and also between the NASDAQ 100 could signaling a potential bounce in the near term to resolve that positive divergence. Now, the last quad witching, which was on June 17, result in a turnaround pivot for the S&P 500. So the question is, will it do the same this time around? The price action into the quad witching close on Friday definitely pointing to a possible bounce. A major catalyst is in play for next week, the FOMC rate hike. No surprise to see a 70 basis point hike, but anything less than that will likely be interpreted as bad news instead of good news, because the only reason for the Fed to slow down on a hike is the economy had deteriorated very badly to cause them to pivot. And this is not the pivot that the market is looking for, at least not for this particular reason. Now, 100 basis point will also be negative. This demonstrates that Fed is acting desperately trying to control the rise of inflation and this erratic action could cause a crash landing instead of slowing down the economy. And no, I don't mean a soft landing. That will never happen because the Fed always act reactionary instead of preemptively, because they always say they are following the data. So by definition, data-driven is after the fact. Now, my takeaway from the market messages is there will be no taking out the June low in the near term. Maybe near the end of the year, after the midterm election, the market will give us a different outlook that might favor a new low. In other words, taking out the June low. But for now, the market has not sent any messages of any sort that telling me it is about to take out the June low. Now, it doesn't mean that it could not change its tone in the near term and send that message out, but so far, I have not seen anything indicating that it will come down and take out the June low. And the Friday's action into Friday's close and the positive divergence between the AD line and the S&P 500, it appears to me that it is setting up a trap to trap the bear, not the bulls. So let me know what you think. Trapping the bear or trapping the bull? Post your thought in the comment section below. And be sure to smash the thumbs up to give it a like and help promote this video. Thank you for watching and stay safe.